What's up everyone, it's Scotty with MoneyVest. In today's video, we are going to be talking a little bit about the S&P 500 and of course Magnificent 7 stocks as well. I'll go over the market concentration in these companies and go over some other reports. Mike Wilson is once again bearish on the market, suggesting for a 10% decline in the S&P 500, with Oppenheimer raising their price target on the S&P 500 to 5,900 by the end of this year. And of course, some other reports suggesting for this market getting too concentrated, just ripe for a bit of a pullback and a correction in the markets here. So I'm going to break everything down. As always, if you enjoyed this video and find it helpful, make sure that you drop a like. I would really appreciate that, and subscribe to our channel if you haven't already. And of course, links to our Discord and Patreon is going to be down below. You can access the entire MoneyVest platform. We've had over 250 people signed up already in about 48 hours since launch. So super excited and happy to have you all on board. And you can, of course, do your entire comprehensive fundamental analysis on individual stocks. Of course, go back and look as much as 20 years of historical financial data, up to 10 years of forecasted revenue and EPS expectations. And again, we're going to be adding more functionality, more features, and more tools for everyone on our MoneyVest platform. So link's going to be down below. There is a 51% discount right now because we're not yet at the public launch. And right now it is a private beta launch that you can, of course, access and take advantage of. So link's going to be down below. We'd love to have you on board. So let's just dive right into it. The first comes from a Piper Sandler analyst suggesting for a deeper S&P 500 pullback, which is coming. In a note, in today's note warning of a potential correction, Piper Sandler stated that deteriorating market breadth and narrowing market leadership are the key concerns for why they believe that there is going to be a deeper correction in the S&P 500. This means that fewer stocks are participating in the rally and investors are focusing on the limited group of high-performing companies. They argue that this undermines the sustainability of the current upswing. And the interesting thing is that we are now at the highest level. This is the most extreme level we have ever seen, going back as far as 2003, since the index is with us, for S&P 500's outperformance relative to the equal weighted index of the S&P 500. So what this simply is, a chart, this is an inverted chart, by the way, for RSP, which is your equal weighted ETF. So all 503 companies in the S&P 500 have an equal weighting in this particular ETF. So if you go over to this chart, what you'll notice is that we've obviously seen RSP not perform. In fact, it actually has gone up. So if I re-invert the scale, it has obviously done well. So it has pushed higher and higher to new all-time highs. So that's good. But of course, on a relative scale compared to the S&P 500, which is SPY, and that is more of a market cap weighted index, because the bigger the companies, the more influence they have on the overall index. And just to give things a little bit more context, this right here is where we are with Big 3, Magnificent 7, and Top 10. These are the three categories that we look at when it comes to market concentration risk. And the interesting thing is the Big 3, which is Microsoft, Apple, and NVDA, make up for about a fifth of the S&P 500 at over 20%, even though they only make up 0.6% of the S&P 500. So that level of concentration is indeed very, very high. It goes both ways, because on one end, yes, the entire market is somewhat dependent on these three companies and their success. And if they start selling off, the entire market is in jeopardy, right? It's under risk. But at the same time, it actually is a good thing, because these are market leaders. These are phenomenal companies. It gives the market a solid foundation that, okay, 20% of the S&P is influenced by these top three companies, super profitable, bright futures, strong cash flows, great management. So a case can be made both for and against this argument. Similarly, Magnificent 7, so those are your top 7 companies, 33, almost 34% of concentration. So about a third of the S&P 500 is in 7 companies, and that only makes up for 1.4% of the S&P 500. And then finally coming over to the top 10 companies, this includes your Berkshire Hathaway, Eli Lilly, Tesla, Visa, all those companies. We're looking at 37% concentration, and includes Broadcom as well. And that's only 2% of the S&P 500. So again, it's kind of crazy to believe that of the 500 companies, only 2% of them control for almost 40% of the entire index. So that, of course, does create a little bit of concentration. And again, if you go back over to that chart, so RSP divided by SPY, so it's going to give you a little bit of a relative performance for the equal weighted index, which just hit a new all-time low. This is a new all-time low for this relative performance chart. And some people may argue that this is quite concerning because market breadth is very concentrated. S&P 500 is pushing higher, but its equal weighted counterpart is underperforming significantly, meaning that we're not seeing a broader rally. We're not seeing other stocks participate. And if I invert this scale, this is the chart that I've seen on Twitter, I've seen on many places, that is somewhat scaring people. That look, this rally is kind of fueled by just a handful of companies, and if they start selling off, well, guess what? We're going to be in trouble. And you can kind of see since January of 2023, so since over 18 months ago, just a little bit over a year ago, 2023 beginning, this underperformance has only accelerated. So if I, again, go back to the inversion, you'll notice the S&P 500 has absolutely destroyed the RSP, which is equal weighted index. So other stocks have really either gone sideways or not performed well compared to technology and semis and big tech and large cap companies, right? So your top 10, your MAG7s and your big threes, they have really just pulled a lot of liquidity, pulled a lot of gains, and you can see that underperformance month after month for the last 18 months. And this can be looked at a couple different ways. If I invert this again, the couple different ways that you can look at this is, number one, if you are looking at it from a more bearish perspective, you can kind of make a case that, oh, it's at an all-time high. Again, if you invert the chart, it's at an all-time high. If you don't invert the chart, it's at an all-time low. So what does that mean? That simply means that, look, we're extremely oversold. You know what? Let me just invert this so it makes it easier, so there's no confusion. So we're at an all-time low. RSI, MACD, everything's really down. So what does that mean? That means other parts of the market, other stocks are going to start moving higher. They're going to start participating in this rally, and liquidity is going to move out of big tech, out of Magnificent 7 to maybe some other parts of the market. So that's one way to look at it. The other way to look at it is the momentum continues, the party continues. And the reason I would say that is because if you really look at this chart, it somewhat looks more like a head and shoulders, right? So we got a left shoulder here, a potential head, and then a right shoulder, and now we're coming down to our neckline. So if it breaks down further, guess what? S&P 500, which is the market cap weighted index, is going to perform even better, and the equal weighted ETF is going to underperform, and that continuous underperformance is going to happen. So there's a couple different ways to look at it. I personally strongly believe that Magnificent 7, yes, they are getting a lot of liquidity. They're getting a lot of attention. They're getting a lot of sort of investor money moving into that particular part of the market. But at the same time, I don't consider them in a quote-unquote bubble. Are they trading at an expensive valuation? Sure. I mean, you can come over to our MoneyVest platform here, and you know what? Let's just go over to a few companies. So if you go over to, let's say, Meta, I doubt that it's going to be trading at an expensive valuation. If you go over to, let's say, the last 7 years worth of analysis here, Meta, of course, is a company that's done incredibly well. You'll notice that it's actually at around 23, 24, 25 times earnings. If you come over to the fundamental analysis under ratios, and again, you can access all of this on our very own MoneyVest platform, you'll notice that price to earnings on a forward basis, 26. Earnings yield on a trailing basis, 3.29%, just under 4% on a forward basis. Price to sales forward at 8.6. We can do a very similar analysis on, let's say, Apple. If you come over to Apple here, again, go over to fundamental analysis under ratios. You can see that for yourself. You can run that analysis across the board. And again, price to earnings forward, 33. Maybe Apple is a little bit higher because it is 23%, 24% more expensive than its 5-year average, right? So 5-year average about 26. Price to sales on a forward basis at 8.78. It's traded at just under 8 on a 5-year basis, so a little bit over 13% premium to its 5-year average. And again, if you come over to Amazon, take a look at that company as well. Fundamental analysis under ratios, and again, we'll take a look at some forward earnings multiples here. So we're looking at 45, 46 when the 5-year average is about 26. So definitely significantly more than its 5-year average, and the price of sales at 3.27 versus 2.59, so almost 20% more than its 5-year average. And of course, NVDA is going to be a lot more. However, I believe that expectations are so high for NVIDIA's future. So we're looking at 26, 24, 25% growth, 132% for this year, and then of course 33%, 14%, 26%. So that growth rate is very, very high. So we're looking at a 46 times in terms of that forward earnings multiple for NVIDIA. So if you come all the way down, 46, 47 times versus almost 30 on a 5-year basis. So that again is a 36% more than its 5-year average, and price to sales at 26, which is definitely very, very high, versus almost a 17 on a 5-year basis, which is 35% more than, of course, what we've seen before. For Google, last but not least, if you quickly come over to Google and come over to ratios and scroll all the way at the bottom, you'll notice Google is actually one of those companies very similar to Meta, trading at a more reasonable numbers here at 25, 5-year average of 17. So again, 26% more than its 5-year average, and price to sales at just under 7 versus 5.5 on a 5-year basis. That's about 18, 19% more than its 5-year average. So yes, there is a case to be made that a lot of these companies are indeed trading at a valuation which could be considered a bit more premium, a bit more expensive. But to say that we're in a bubble or we're going to start seeing a significant deeper correction or pullback, I feel like is a little bit more far-fetched. I think, in my opinion, that momentum is going to continue, maybe with some dips or some corrections along the way, which are only going to be buying opportunities, in my opinion. Morgan Stanley's Wilson says 10% fall in the S&P 500 by U.S. election is highly likely. Again, Mike Wilson has been wrong consistently, especially this year when he's been expecting for a market correction and a dip and a pullback, and just markets have not really abided by those rules, and they have just continued to plow higher and higher. Valuations to me look very unexciting is what he says. So a lot of that sort of analysis and that thesis is coming from on the back of valuations, which again, I guess there is some case to be made, but markets coming down strictly because something looks more expensive, that's very unlikely to happen. It's most likely going to be triggered by some type of an event. There has to be a catalyst. Valuations can stay expensive for a very long time. They can stay cheap for a very long time as well. So just because valuations are high or low does not mean that there's going to be a reversal. And there has to be a catalyst. It makes for a good buying opportunity versus a good opportunity to de-risk, or maybe if you want to sell some calls, but that's a whole different story. But timing the market based on valuations has never worked, because valuations can remain expensive for a very long time. As the saying goes, the markets can remain irrational longer than you can stay solvent. Oppenheimer raises the S&P 500 target to 5,900, so that again is going to be a very strong number. And the MAG7 earnings preview, get ready for a bubble bursting. So again, I just went over the fact that yes, they are expensive, they're trading at a bit of a premium valuation, but to say that they're in a bubble, to me, seems a bit more far-fetched at the moment. So going over to very quick analysis on these companies. So NVIDIA resistance is going to stay put at about $140. So that's going to be that level to keep in mind. Support level down as low as 117 to as low as $97 per share. So those are the key support and resistance levels to watch for NVIDIA here. Talking a little bit about Apple. Apple continues to trade at an all-time high, which is incredible. Of course, RSI and MACD also very, very overbought. So if I just copy this and paste it on this chart here very quickly. All right, so let's just do this. Okay, there's something wrong with the RSI, so we're gonna have to figure that out. Let me just see if I can paste it here. Okay, I'll have to fix that out later, but let's just go over to Apple over here. And again, you can see the RSI, the MACD, incredibly overbought at the moment for this stock. NVIDIA we already went over, but just take a look at the RSI, 75 for Apple, and again, MACD also at a bit of an extreme, pushing higher. Of course, it broke out from that resistance, came back down to validate that support, or resistance acting as a support, and then of course, pushing higher to new all-time highs as well. So something to keep in mind for Apple here is that technically speaking, yes, it's a bit more overbought, so wouldn't be surprised to see a bit of a pullback, something that we have already witnessed back at around here, about 5.5% pullback for Apple. Amazon, on the other hand, also trading at pretty much new all-time highs, almost at a new all-time high, struggling at that resistance. RSI almost at an overbought level, MACD and the L3 banker oscillator, everything suggesting for some momentum starting to slow down for this company. But right now, this right here is going to be that resistance right now that it's struggling to break out of, and that's going to be close to $200 per share for Amazon. Support level is going to stay up roughly around 188, 189 for Amazon. Talking about Tesla, and Tesla here has had a very, very strong days, as we already know. I mentioned this in our Discord as well, that there's a huge resistance that it's coming up to. And that resistance is going to stay up roughly around $258 to $260. So anything inside these two red rectangles, a very, very important level to watch. Needless to say that it's extremely overbought at the moment with the RSI well over 85, the MACD and the L3 banker oscillator. So just got to be super careful with Tesla here at these levels, considering how overbought and overextended the stock is at the moment. NVIDIA we already went over. Let's just quickly go over Meta and Google. It's going to wrap up, and of course Microsoft as well. By the way, Microsoft we didn't check out on our platform, so let's just quickly go over to Microsoft here so I can show you what does the valuation look like for Microsoft, which I do think it's a little bit more on the higher end compared to some of the other companies. So forward multiples almost at 38 compared to 28 on a 5-year basis, and forward price to sales at over 13 compared to 10.4 for the company, which again is 25% more expensive than compared to its 5-year average. So again, a lot of these companies are trading at a bit of a more premium and expensive valuation, but to say that they're in a bubble is a bit more far-fetched because they've got a backing of very strong user base, customers, revenues, cash flows, all that good stuff. So bubble is really something that doesn't really have any value, right? Because a bubble is transparent. If you poke a bubble, there's nothing there. But to say that these companies that are very well established with very strong revenues and cash flows are in a bubble, again, is a bit more incorrect in my opinion. So Microsoft, we've got a support here now, sitting roughly at around 540. This is actually Meta, I'm sorry. Meta support level here inside this support in the green rectangle in the 514, 515 for this company, down to as much as 530. And of course, almost new all-time highs at $542 and a much stronger support sitting at 450s to 475 for Meta as well. And then finally, talking a little bit about Google and Microsoft. So Google here also hitting new all-time highs, consistently pushing higher. Support level is going to stay put down at 179 to 173, all the way down to inside this green rectangle at 152 for Google as well. And then of course, finally going over to Microsoft from a technical analysis standpoint, again, trading at new all-time highs. A lot of companies are trading at new all-time highs. Support level for Microsoft down to 430, down to $417 per share for Microsoft as well. So hope you all enjoyed this video and a full update on where we are with Magnificent 7. Let me know your thoughts down in the comment section below. Again, if you want to get access to this entire platform, there's a lot of features that we're going to be introducing over time, and you'll be able to get early access. Link's going to be down below. And of course, you can lock that pricing forever until, of course, you cancel. Link's going to be down below. We'd love to have you on board. As always, make sure that you drop a like, subscribe to the channel. Happy investing, and I'll see you all in the next video.